Hi, good week to all. This is Kelvin here again. Welcome to this week's latest edition of our weekly technical outlook on the major stock indices, where I'll be covering with you the latest trend bias and key levels to watch for this week on the SPX 500, the Nasdaq 100, the Hong Kong 50, the Japan 225, and the German 40 indices for the week of 27th of June to 1st of July 2022. So before we start, let's take a look at the disclaimer slides first. Okay, so before we jump into the technical analysis of the various five indices that I will tend to share with you, let me take a walk through across the group on the major US stock indices from US, Asia, and as well as Europe, the momentum analysis. Okay, so what I could see over here is that I actually segmented according to different ta- different what I call it columns, weekly performance, which is last week performance, its prior week, and as well as prior 4 week average, and I get the difference of the last week performance versus the prior 4 week average. That means if this level is greater or is than the prior 4 week average, that means momentum is picking up. And what I did over here, I also plot its momentum trend. That means taking into account of the difference of last week versus this particular difference 4 weeks ago. So it's something like a 5 week short-term momentum trend. So if this trend is picking upwards, that means we are talking about momentum, short-term momentum is picking up as well. So let's take a look at US, the major US stock indices. So if you recall last week technical analysis outlook, which is my video, we did highlight that the S&P 500 and Nasdaq 100 is coming very close to key medium-term pivotal support, where we're actually potentially ripe for a 1 to 3 months of corrective rebound. Okay, bear in mind it's a corrective rebound, it's not a major bottoming process. That means IE is only to retrace a certain portion of the first phase of its major downtrend that has taken shape since the start of this year, if we take into account of SPX 500, which is its all-time high is in January this year, and for the Nasdaq 100 will be in November last year, where it actually recorded its fresh all-time high, and eventually the rebound did actually materialize as expected. So we could see the US stock indices actually outperform against the rest of the pack if we compare it to the peers in Asia and is in Europe. Okay, 6.45% on the SPX 500. The Nasdaq 100 definitely is the outperformer, no doubt of that. Why? Because if you look at the last 3 to 4 weeks, Nasdaq itself was actually the worst performer because due to its more higher beta, we call it sensitivity, 7.45%, Dow Jones 5.39%, and the Russell 2000 small cap at 6%. So what's interestingly, all in all, if you look at their momentum trend has been shaping a U-shaped reversal. That means i.e. telling to us that the short-term momentum is actually trend is actually picking up. So bear in mind, what is this momentum trend? This momentum trend is actually the difference. That means this is the difference where I take into account of last week performance minus its prior 4 week average, and also compare it to to track this difference 4 period ago. All right, so it's 4 plus 1 that gives this momentum trend. So what I could see over here is Hang Seng itself was China related, we call it stock indices also perform relatively good as well, or relatively robust last week at 3.1% for the Hang Seng Index. The China Big Tech, which is represented by Hang Seng Tech Index, 4.11%. So the Nikkei 225 finally did a reversal from last week dismal underperformance, which is negative 6.7%, to actually record a positive weekly close at positive 2%. And the German DAX index, one of the still worst uh, underperformer among the global major stock indices, did also fairly well because it actually reversed a significant portion of last week negative performance of negative 4.6% to close almost unchanged. I would say negative 0.6%. And if you look at its momentum trend, it's also sharply picking up on the upside as well. So all in all, what we could see is that the performance of these major global stock indices has started to be on the mend for this potential 1 to 3 months corrective rebound phase that is taking shape last week, since the start of last week. All right. So before we go into the technical chart again, let me share with you the 11 sectors performance. Okay, so this is the 11 S&P sector performance. So what I could see is that very interestingly in this outperforming phase, the one that is performing the best in Q1, Q2 has now started to be the underperformer, which is the energy sector, which is negative 6%. Why? Because those who actually followed me on social media, which I have a Twitter account, which I tweet almost every day talking about the narrative that is playing out in the global financial market space. Why? Because energy is now, there's a potential risk of a global demand destruction, which is being inherent in this slowing down of US future forward-looking inflationary expectation. All right. And also because of this lower inflation expectation, this is the gist that actually causes this outperformance of technology and growth related stocks that is pushing this 1 to 3 months of potential corrective rebound that is seen in the US stock indices, as well as the rest of the world. And also, do not forget over here is that China related stock market actually performed very much better than the US stock indices. For evidence, it actually didn't break it much low. And the reason all explained in my social media account, which is my Twitter feed. Okay. Later I'll share with you all how to actually follow me and get a dose of what's going on in the global financial market space. So all in all, worst performer was energy. No surprise to us. And the best performer was the consumer discretionary, which is has the biggest weightage in Amazon and Tesla. And also the growth related stock technology also performed a fair bit as well in terms of outperformance, 8.8% last week. Okay, now without further ado, let's go into the technical chart. Okay, so before we go into the strategy chart, so bear in mind those that follow me already, this shouldn't be we call it a strange norm to you all. So at the end of the day, most importantly, what we're going to do over here is we're going to drill down to the 4 hour chart will be the strategy for this week. But before that, let's take a look at the longer term picture on the daily chart first. So on the daily chart, what we could see over here in terms of the elliott wave perspective is that the first phase of this downtrend, major downtrend starting from the all-time high on S&P on January this year has more or less ended. So this is what I call considered as wave A. And right now we are potentially doing a corrective multi-month, 1 to 3 months of wave B, potentially retesting this former expanding wedge resistance, pullback resistance at 4217, 4310 level. And also the RSI last week has managed to shape a bullish divergence at this oversold region and still has a bit more room to go before hitting its overbought region. Also indicating to us that from a medium-term perspective, we still have a fair bit of room to go higher potentially. So how about the 4 hour chart? So bear in mind that 4 hour chart on the SPX last week, we have a 3840 upside trigger level, and our key medium-term pivotal support to maintain our bullish bias for last week was 3610 slash 3580. So the price actually already cleared above 3840 upside trigger level. So what I could do over here for the sake of prudency, we will tighten this week key medium-term pivotal support up to 37.75 to maintain our bullish bias. But bear in mind on the 4 hour RSI, which is a short-term RSI, indicating that in short-term upside momentum, it's a bit overstretched on the upside. Why? Because it's approaching a relatively extreme overbought level at 77%, which i.e. could translate to a potential pullback after it tests this resistance level, which is 3980 that we also mentioned last week as well, 3980. So at 3980, there could be a potential pullback towards 3840, maximum 3775, before another potential uplift towards 4075, maximum 4284, which is close to this upper boundary of the short-term ascending channel in place since April 2022 high. All right, but however, if you have a 4 hour close below 3775, then we will have another kind of a chopper decline to retest this key longer term support level at 3610 slash 3580. All right, now moving on to the higher beta Nasdaq 100. So very similar on the Nasdaq 100 chart on the daily chart, we also start to see is that the only difference over here is that Nasdaq 100 made an all-time high much earlier in November last year. So from November last year, all-time high all the way down to the low of 16th of June, more or less, this has kind of completed its major first phase of this downtrend, major downtrend, and we are in the works of this potential 1 to 3 months corrective wave B from a elliott wave and fractal analysis, potentially the resistance at 12,960, 13,500. Now, moving on to the 4 hour chart, which is the strategy chart for this week. So bear in mind over here is that the Nasdaq 100 has really cleared also its the upside trigger level, which is around 11,640 level, and almost now coming to the resistance that we mentioned last week at 12,450. And in fact, it already hit the first resistance at 12,070. So all in all, right, similar movement on the 4-hour RSI as seen on the SPX as well. So on the short term, 4-hour RSI indicate to us that the short-term upside momentum is getting a bit overstretched. Why? Because it's coming very close to a extreme overbought level at 76% and 83%. So all in all, right, what we could see right now over here is that potentially we could start to see a pullback upon hitting 12,450 towards 11,950 maximum at this key medium-term pivotal support, which will be tightened for this week on the Nasdaq 100 at 11,630. So as long as this level holds, we are maintaining this bullish bias to actually hit the next resistance level at 12,770, which is the swing high area of 6th of June and 8th of June this year. And bear in mind that if we have a 4-hour close below 11,630, we will actually negate this bullish tone to see a kind of a whip soaring, we call it a choppy decline to actually retest this key support level at 11,000 slash 10,960 on the Nasdaq 100. So still maintaining that bullish bias with a tightened key medium-term pivot support on the Nasdaq 100 as well as the SPX 400, SPX 500, pardon me. All right. Okay, so now moving on next to the Asia major benchmark indices, which is the Hong Kong 50 index or the Hang Seng index. Hang Seng index. All in all, right, the index actually pushed up as expected and it's almost coming close to the resistance zone or target that we mentioned last week, 22,260 slash 22,640. So for this week, we're actually turning neutral again. Why? Because bear in mind that don't forget last week we recall that this Hong Kong 50 is still evolving in this potential ascending triangle configuration. And now we're actually coming very close to the upper boundary of this ascending triangle configuration with the RSI coming also pretty close to an extreme overbought level at 77%. So this is the bear market, is a 4-hour chart. So indicating to us the short-term upside momentum is a bit overstretched where we see another round of consolidation within this ascending triangle configuration back to the bottom of the range at 2278. So what I going to do over here, we are being neutral between these two range, the upper limit and the lower limit of this potential ascending triangle configuration at 22,640, lower boundary at 2780. Unless it has a 4-hour close above 22,640, then we could actually potentially validate a further potential up move towards 23,350 slash 23,670. A break above 23,670 should take us up towards much higher towards 25,050, which is a key medium-term resistance. Why? Because it's confluencing with two graphical levels, 10th of February swing high area, and also this major descending trend line that is in place since, okay, that means we got to go to the daily chart, in place since February 2021 high. Okay, now acting as a resistance at 25,050 as well. All right, back to the 4-hour chart. So now if we have a 4-hour close below 2070, 7080, then we could see a drop towards 19,090 and also close to the 12th of May swing low area at this 19,200 region level. All right, so neutral for now on the Hong Kong 50 index. So now moving on, next will be the another major we call it Asia indices that I share with you will be the Japan 225. So if you look at the Japan 225 or the Nikkei 225, it's also pretty much in a sideways range since 8th of March 2020 low, still trapped below 8 of trapped within 8th of March 2020 low, and as well as the 27,760. So what 27,760 is a kind of a descending trend line resistance that is in place of 14th of Sep 2021. Previously, it did a failure bullish breakout on 7th of June, but managed to actually cap by this former trendline support, now turns into a pullback resistance right below 28,680 before reintegrating back down below. It's over here. So RSI managed to stay above the 28% support level, but hasn't break above this corresponding descending trendline resistance, which is acting as resistance correspondingly at the 63% level. So all in all, what you could see is a kind of a trap within a very complex sideways range configuration on the Japan 225 as seen on the daily chart. So going towards the strategy for this week, if you recall that the Nikkei 225 or the Japan 225 has managed to hit our resistance level because last week we were bullish at 26,700. So all time printed a high at 26,900 area this Monday morning Asia session. So what we do over here is that we will actually tighten the key medium-term pivotal support to last week's swing low area. We also correspond to 12 of May swing low at 25,535. So looking for a push up towards this 27,500 slash 27,760, which is actually the descending trend line resistance that I draw earlier on the daily chart in place since 14th of Sep 2021 swing high. But however, if we start to see a 4-hour close below 25,535, we could actually it actually invalidated this preferred bullish bias scenario to actually see a push down towards the range the complex range support level range configuration support level at 25,500. Okay, now moving on to the German 40 index or the DAX. So for the DAX itself, is so pretty much trapped within a range as well, very similar to the Nikkei 225 or the Japan 225. 7 March 2021 swing low area 12,430, and also failure to surpass above the range resistance at 14,810, 15,030, which is so the 200-day moving average. So on the 4-hour chart, you still recall that the strategy for last week we were neutral with a lower boundary at 12,940. So very interestingly, the index actually came down and test right at this 12,940 lower boundary of the neutrality zone that we actually highlighted last week. Have an intraday low at 12,830 and it shaped a bounce. So the way it shaped a bounce, the RSI also flashed a bullish divergence. So we could see a price index show lower low on 23rd of June comparatively to 17th of June, but the RSI managed to flash a higher low over here. Okay, and this bullish divergence has been in place since the low of 13th of June. So looking to us saying that, hey, this downside short-term downside momentum has more or less abated. So we actually has a stronger case to actually turn bullish for this week right above 12,940 slash 12,830 to play at least a short-term bounce within this messy range configuration towards the resistance at 13,680 slash 13,900 level. So which is also the FIBO retracement taken for the high of 6th of June all the way down to last week 23rd of June low. Okay, close to the 50% level. And however, if we start to see a 4-hour close below 12,830, it will actually invalidate our short-term push-up scenario to see a further drop to retest this complex range support lower boundary, which is the support level at 12,500 slash 12,430. So all in all, right, to keep it in a nutshell over here is that right now we are now seeing the start of this potential 1 to 3 months corrective rebound across the board, and except for we are still maintaining our bullish stance for the indices that I shared with you for this week, except for Hong Kong 50 because its elements kind of mixed. Why? Because it's coming towards the upper end of this um, ascending triangle range configuration where we could start to see another round of messy sideways configuration for this week before another potential push up. And before we go, I'll share with you all, this will be my social media account where I tweeted daily on the mechanics of what's going on in the global financial markets from FX, stocks, and commodities, as well as fixed income. So if you want to get a dose of what's going on in the market, do give me a follow at just open a Twitter account. It's free. Then follow me at Kelvin SC Wong. You can actually add me on Twitter. That you're able to get a dose of what's going on for this week. And in fact, I highlighted a chart of this week as well, which is the Euro Yen. Why? The reason why you can actually read it more over here. So with that, have a great trading week ahead, and I'll see you again in my next video.